And I'll just let everybody do their introductions, but just a great segue from the last panel, right? You had someone talking about the regulation, someone talking about how we want to handle these things and look at them and manage them, and insurance, but also he talked about the Bitcoin ETF, which Alex's firm has been involved in. So that's a really good segue here. So I'll just start by talking about myself for a minute. I have a family office. I've been in and around the crypto space for a long time. I'm really a deep tech guy, which is crypto, blockchain, AI, quantum computing, all the really geeky stuff. Some say I pass for normal, but as a super nerd, but some say I'm not normal. But I love my nerdy stuff. So, being in and around it, I have the ability to sit with fine gentlemen like this and hear their opinions. Why don't we just go in order down the row? Everybody just say who you are, where you're from, and what you do, and then we'll start talking about assurance and transparency.
Great. Thank you. I'll keep it short. My name is Sean Kiernan. I'm the founder of GreenGauge. We're a Web3 fintech that does two things. We give accounts to our clients that are crypto-friendly, but they're fiat, and we do lending with partners. We've done about $250 million of lending, typically crypto-backed, and we're moving into the SME lending space now with Coinbase.
I'm Hemant Pandit from Cryptio. We are a data platform for accounting, reporting, and compliance for exchanges, banks, fund issuers, anyone who is building an enterprise or business in digital assets. So yeah.
My name is Lake Shabir. I'm from Ernst & Young, a Big Four firm. I support anything and everything to do with digital assets and blockchain, but specifically focusing on assurance.
My name's Alex. I lead the 21 Shares business in the UK. 21 Shares is an issuer of cryptocurrency exchange-traded products. Company's 6 years old, based in Switzerland. We have about $7 billion in assets under management, nearly 50 products. Recently listed some crypto products on the London Stock Exchange as well, and now building out our UK business.
Fantastic, great panel. I'm really excited to get started. So, just building on what we talked about this morning and building on, what people have been talking about all day, we're talking about assurance and transparency. So, I think there are two sides to that coin, right? There's this set of rules that either a regulator or someone indicates are important to be followed in order to make sure that people are selling what they say they're selling, or that the things are there that are supposed to be there. And then there's the consumption side, whether it be institutional or whether it be individual investors who have things that make them feel comfortable, right? And make them feel that whatever regulatory framework is being followed, that they have confidence in the system, right? Which is 90% of the monetary game, however you're exchanging value. So, a robust assurance framework. What does that look like? Laik and why don't you guys start with, and you're more on the technical nuts and bolts of a product that checks the boxes and makes sure that everything's there. And you have I think an overview of what a framework looks like.
So why don't I start with the framework, and then I'll probably need your help from a product perspective.
Sounds good.
So from a framework point of view, there are assurance frameworks that do already exist. Now it's all about making sure it can be adopted in the digital assets and blockchain, cryptocurrency space. So what we've been focused on is quite a lot on that, and we've helped a lot of industry bodies in making sure the standards could be tweaked in appreciating how to manage risks for firms. So those type of frameworks could be under financial statement audit. It could be for smart contract reviews. It could be in providing ISAE 3000 type reports, which get provided for a lot of platforms, be it an exchange, 21 shares equivalent, or a custody provider, or a data service provider as well, or even pricing point of view as well. And that holistically covers many aspects of business. It could be technology, it could be custody for private keys, it could be about code, etc. But I think the important thing to also bear in mind is that we definitely need firms like Cryptio to support that, because they're part of the ecosystem to build that trust. So I think that's a broad framework, but then also the product point of view of Cryptio is going to be brilliant as well, because they enable that level of trust being provided to institutions.
Yeah, maybe to add like the technical problem set here. So basically, you have an exchange, you have a fund, you have a bank. When they're custodying crypto assets on behalf of their users, they have to be able to prove to the regulator, to the auditor, that not only do they have those assets, but also what's the full audit trail of how those assets got there, what's the cost basis, who are the liquidity providers. And this was kind of the promise of crypto, of the promise of digital assets, is that you have these public blockchains, immutable ledgers, where anyone can go and see what happened, what's the trail of movement of these assets. But there is a paradox here. And the paradox is that the data is public, but being able to extract that data out of the blockchain and making that intelligible to a user of these products or a regulator or an auditor, there is a challenge here. So there's the challenge of pulling the data out of the blockchain, and you might say, well, we have explorers like Etherscan or like blockchain.com, and they're great. But there's a lot of information that's missing. So if these funds or brokers or exchanges are doing trading off-chain with OTC desks or with certain liquidity providers, you have to pull that data into the mix to give a full picture of where the assets came from. Then you also, on the on-chain side, indexing is not kind of a black and white thing. There is, for anyone to have confidence in a transaction history, even on a blockchain, you have to trust the software that's pulling the data from the node and turning it into a ledger that's user-readable. So this is kind of like the new space here, a new space where there's new infrastructure that's required to be able to make sense of this audit trail of where the assets started and how they've entered into the custodian's balance sheet, into their ledger. And that can then be used and proven to a regulator, to an auditor, or anyone who's sort of interested in this financial information, to say that, yes, this fund is collateralized, it's saying what it has. And that's an environment that you can then have a thriving digital asset economy on, where there's financial integrity that's guaranteed by the promise of this immutable ledger with the infrastructure and the assurance that makes it legible and trustworthy.
That's a very sophisticated answer. I like that. I think that what comes to mind for me when I hear that, and I'd love to hear what Alex thinks about this, is as a person who's been around banking pretty much my entire life and kind of grew up with it because it was in my family for generations. I saw the way that these things were done through broker-dealers and, the forms that needed to be supplied to the SEC and, how a broker-dealer or an investment bank would, fill out all their forms, do all the things the SEC said, follow all the rules, file their S1, go effective, do all these things. And then there'd be a distribution, and all of these things that we're talking about were happening outside of the world of the blockchain. But what we're doing now is we're disaggregating it, right? We're actually saying, you know what? The bank is going to have less control, right? We're saying that the bank is, there's not going to be this relationship with, some, series of accounting firms where they're going to do all these things. They're going to hold all the documents. They're going to custody all these things. We're going to be able to kind of move it around. Alex, I'd love to hear from you, someone who's been in traditional banking and then has moved into this space. Do you see that kind of disaggregation? How different is it? And how comfortable are you with the assurance that's there? And I'll have a follow-up question after that.
Yeah, thank you. Thank you. I think the industry is really at an inflection point. And going back to 22 when we were living through the crypto winter, and one of the things I remember talking to our investors and our target audience is traditional investors, is they wanted to, with so many firms struggling during the crypto winter, actually doing due diligence became more and more important. Right? Actually being able to show that you had an audit trail out there, proof of reserves, it became more and more important. This is, I think, something the traditional finance world went through, especially after the global financial crisis, 2007, 2008. And I think even though the crypto winter was very painful to many in the industry, it actually has forced the industry to grow up a little bit and think a little bit more about how it approaches auditing practices. Because if the space is really going to institutionalize and mature and evolve, it needs to get these things right. So when I'm hearing about what you're doing in the space, hearing about more traditional accounting firms getting involved in the space, that's a really important part of the maturing phase. And I think things are improving, but I still think there's a long way to go. Especially when it comes to auditing. But things are definitely getting better.
That's great. First of all the things you were saying, I felt like you were like reading my mind for a minute there. So, but I would go even further back. I'd go back to like when the American public or the world started really investing in stocks and bonds. Yeah. Right? And then there was this huge speculative craze, right? And then there was a crash. And then there was the 32 Act and the 33 Act, right? And then there was, a run like we've never seen before for the past 100 years after the regulation came, after the pain. Yeah. So, sometimes, it
usually takes a crisis to actually make things change.
Right. Yeah, right. And like Leonard Coase used to say, right? I don't care what the rule is, just give it to me and I'll transact around it. So, and I'll follow into, Sean, because you're dealing with people who don't have like a bank behind them, right? Maybe a high net worth individual, but someone who doesn't say, I'm giving you my institutional money and I have all these sophisticated systems in place, to make sure everything's kosher. How do you feel about where we are and the comfort level that you can give to your clients and how you transact around the regulatory scheme at this time?
So first, a caveat, we're not regulated ourselves, but we offer regulated facilities through partners who are. But we still bear a fiduciary responsibility, meaning that we look after our clients to make sure that they're taken care of. And I think the big thing for us, as we see DeFi generally, is it's a redefinition of the plumbing of financial services. And for me, it's hugely exciting to see that happening now. And we've discussed kind of the post-war period, the pre-war, in the context of securitization kicking off. But we're now having technology advance to a stage where financial services and regulation that's been built doesn't really correlate exactly with what we're seeing in the plumbing. And when I talk about security,
I want to hear more about that. Yeah. Build on that. Yeah. I want to hear about. I want to. Let me be a plumber. I want to see what's. Let's turn the rock over.
And I mean, we're doing, I mentioned very briefly, this collaboration with Coinbase to bring SMEs that maybe aren't getting access to lending from banks or from private credit, now the trillions of private credit out there, at a scale that's a good price point. And we're doing this in the form of commercial paper, which you're probably familiar with, is an unregulated product, but behaves like a bond. It's a discount note.
This is biting off of an earlier, I don't know if anybody was here for our earlier panel, but this is biting off of an earlier panel. We should tie this all in, and we should have a third panel. Keep going.
And because it's an unregulated product, you can innovate. There's a little bit more freedom to work within the system, but one of the concerns that we've had is when you tokenize instruments like this and you're using a DeFi backend to bring it to market, it starts to behave in some shape or form, particularly when it's traded, like a regulated instrument. And so we always have concerns about how do we deal with this, how do we make sure that it's done appropriately. But to do it in a way that's holding our heads high, you need to work with regulators. And so for us, we're doing this initial collaboration in the context of Coinbase's registration ADGM. So Abu Dhabi has licensed kind of effectively a sandbox-style environment, but with safety rails. And our job is to bring traditional businesses that are looking to post debt into a digitized space using USDC or USDT, so stablecoins. Again, the killer app for us to access these rails. But to handhold that whole process so a financial controller or a CFO has the safety and assurances that they need to make sure that they can come into this space, use it, get the money that they need, and also take it back out and use it for fiat transactions for their business. So our job is as a Sherpa, if you will, to access this new plumbing, working with partners who are either regulated or behave like they are regulated.
Right. So I think that's amazing because earlier in the day we were talking about we were talking about corporate bonds, and an AI solution that's being applied to get better pricing predictions and discovery for corporate bonds. But we're also talking about mortgages and real estate, and how the only real difference between the two of them is you can even out the default risk on the corporate bonds, with insurance in the commercial paper market, right? And I think that's another thing that we're seeing in the maturation of this market, is that once again a disaggregating or like a rethinking, right? Again.
Completely, and we will still have the traditional roles for insurers and broker-dealers. We still need to have that last mile. But again, it's the plumbing, and when that changes, the efficiency is achieved. You don't need necessarily an escrow agent in the same sense. You can reduce the number of hops that money takes, or potentially credit creation takes from start to finish. And in saving that margin, we think we can give money back to both the lenders and the borrowers in the form of a saving spread.
And just what you said about broker-dealers, look, I mean, I think you're going to need some kind of broker-dealer, but the question is, how commoditized is it going to get? I think you're just going to, see a lot of the friction gone, and you're not going to need, these people out there running around accumulating things for you that you can kind of do yourself, particularly if you have, the compliance documents in there. And Alex, I'll go back to you on, you're doing these large sophisticated transactions. What are the, when you're doing a large transaction, right, and you're working as an investment bank, and you're dealing with a technology that is replacing a system, like a human system, what are some of the obstacles? What are the, where are we in the technological evolution of having tools that are similar like Cryptio that can make us feel comfortable that the full transparency is there?
Yeah, I mean, so coming from the traditional world, I think actually, when you go into crypto, there are a lot of nuances in crypto that just don't exist in the traditional world. I think you've seen some traditional players getting involved in crypto, and they kind of try and use the same rules-based means testing as they use in traditional world, the way they look at equities, the way they look at bonds. It doesn't work like that. Actually, crypto works very differently, and you really need crypto expertise to be able to build crypto products. So, this is one of the questions that I get asked a lot at 21 Shares is there's a lot of crypto ETPs out there. Why 21 Shares versus one of the traditional players? And actually, 21 Shares has, for 6 years, built a track record of building and launching crypto ETP products, and a lot of it is on proprietary platforms. It's platforms which the founders set up 6 years ago, end-to-end, an end-to-end platform that facilitates the whole crypto journey. And that's really, really important. It's a different kind of technology. It works in a different way. You really need to know it inside out. I think having that in-house knowledge really makes a difference when we go out and speak to customers.
I 100% agree with that. I've seen, in institutions that will remain nameless, large institutions that invest in these things, a model review process that is not what it should be.
I mean, this is a more, I would say, a crypto audience. But I think one of the things that really strikes me about speaking to investors is how much education actually needs to be done to promote the industry. And this is something we're very focused on as a firm. You know, people over the last few years have read the headlines about crypto. There's a lot of misinformation in there. And you really need responsible firms to come out there and actually focus on education and thought leadership. And really articulate what crypto is. What does blockchain actually do? What are the benefits of tokenization? You know, what are the benefits of DeFi? And that's a journey that people have to go down. But I think it's not just about the technology. It's also coming out with education and thought leadership. That's a big part of it as well.
I completely agree. You know, and Leek, I'd like to go back to you on, you know, just where this is kind of heading, because, you know, when I talk about model review, you probably know what I'm talking about, you know, which is, you know, you've got, you know, some kind of technology-based product, whether it's crypto or something that's using AI. You're at a bank and you're like, we're gonna roll this out. We're gonna do this. And then you have some guy who, like, you know, may not have a state-of-the-art knowledge of technology, who's like reviewing it without really an understanding of the use case, and, you know, looking at it like almost like a pipes and plumbing IT, like is this going to break, you know, that type of stuff. How have you guys handled that need for some real technical sophistication when looking at the actual product? When we're talking about assurance, transparency, you know, someone who really, you know, looks at the model and says, okay, I know how this thing's working.
It's no different than bringing a specialist into an engagement, checking the plumbs and the pipes. So whoever is a specialist needs to be part of the work that you need to do. So whenever we have to do this type of work, what we do is we bring the best of people from wherever we have a best team. So we've got center of excellences across the globe, right? A lot of people ask me the question, like, you're based out of Edinburgh. What has blockchain got to do with being in Edinburgh? And it doesn't really matter. I do stuff across the whole of Europe, like with Cryptio. I've gone up to Middle East. I've gone to Turkey as well. I've gone to places across the whole of Europe as well. Doesn't really matter. The thing that matters is bringing the right people to the table of what engagement is required. I'll give you an example. If we have to do with something very specifically on zero knowledge proof, on privacy, I'll bring someone else in the team that I know from my network that will be able to talk about it 100%. Right? Equally, if you want to talk about providing smart contract reviews, I'll bring someone from across the globe that I know very well sits somewhere else. And I'll be like, you know, you're great with Ethereum smart contract reviews. You should be part of the team to make sure that we can do the right thing for the client. So the main thing is, what do firms and individuals or clients need? And what we do is we bring the best to the table to make sure that we can deliver the best value for our clients. I mean, at the end of the day, EY has a very big value and a brand across the globe. So the only thing that we do is best is bring the best to the table. And that's it.
No, it's great. And that makes sense. You know, I think that there's something else that's kind of a nuance here, particularly as you're relating what you're talking about a thing, and you're talking about a person that's investing in the thing, right? And so you may say, you know, you may explain that thing in a very technical way, right? As an engineer or a scientist. And then you may have a person who invests in that thing who's not an engineer or a scientist. So, you know, Sean, like, I know you're dealing with, you know, people who don't have, you know, a ton of advisors who are like telling them how every little thing works. You know, it looks like we're doing all of these things, and I really like to bite off of the concept of education, right, that Alex was saying. How do you convey, when you're assured that the product is good, you're assured what you're doing is good, or the transaction is structured right, how do you convey that assurance to the client?
So I think first off, generally we have a bad education for financial services across the West. I think to lift people up first to understand the basics, let alone financial markets and capital markets, is already a step. And if we're dealing with what we are generally dealing, we have two types of clients. One is a crypto business that uses us for the fiat accounts, and they're typically very sophisticated, they know what they're doing. And the other group are traditional businesses that finance is really not the top of their agenda, other than getting cash in, cash out, settling the books. And if we're talking to them about, say, debt activities, which we're now starting to increasingly speak to middle market CFOs and financial controllers, these are individuals that might have an accountancy background, but they do not have a financial markets background. And education there is absolutely key, because we're trying to explain to them that they have other choices than just going to their bank. They can access financial product in a way that they might not have envisaged before, and we're explaining that you can do this in a way that involves crypto. So let's just say we have to take them with us and explain that these solutions actually save them headache or cost.
They can do more sophisticated things without
business.
having to have a treasury department. You want to say something?
Yeah, maybe just to add on that. So this is so common where you have, crypto is very interdisciplinary. So you've got people who maybe come from an accounting background, don't understand digital assets, people who understand digital assets really well, don't know what the assurance framework should look like. So what you really end up with is, let's slice the pie in this way. You're building a product and you want to understand sort of the technicalities of how does the funds move on different blockchains, how do you, bridge the assets, if you're bridging the assets, how do you track all this activity? And in that, you need someone who understands how the chains work, how the custody infrastructure works, how to track the transactions, how to tag the transactions, how to create a transparency framework so your users can track and tag all of that. So for example, if you're a wallet, if you're building a wallet, right? I know that we have, Backpack in the audience here. We have, folks building on Solana. You're building a wallet, you're building a DEX. This is non-custodial infrastructure. And here you really want to think about, how am I making sure that when a client is signing a transaction, they're signing what they expect to be signing? How do you make that information user readable? Whereas what you were saying earlier is you have this other side of the market where it's more of an investment use case, right? You're not building a product, you're just looking to get exposure to assets, and you want to do that in a safe, secure way and do that in an assured framework. In that kind of a context, what you really want is sort of assurance from the likes of, EY, where you don't want an FTX situation where, okay, I've got my assets held in this exchange, and it's collateralized by their own token that they're valuing themselves. If you are, there's the assets and whether they exist, and there's also what are they worth, and there's manipulation that can happen in both. The beauty of blockchain is the assets and whether they exist, you can make some really strong infrastructure to make that indisputable. And that's where Cryptio plugs in as well. But on the valuation side, this is like a traditional markets problem of you need sort of prudence around how are we valuing these assets. And there are frameworks around this. So the FASB, which is the US authority on accounting principles, they basically have got a framework of fair valuation of assets where, okay, you can mark Ethereum to the fair value of Ethereum, but wrapped ETH, you can't, which is a wrapped asset. Now here you've got some on-chain event, which is wrapping an asset that now adds smart contract risk that has an impact on valuation. Now I might be getting a bit more technical here, but the point is...
But you're bringing up important issues. I mean, these are the kinds of things that caused 2008. Which is the layering of risk that no one else was seeing. Keep going.
Right. And what you don't want to do is also underestimate smart contract risk, which, a lot of the time you have these, DeFi protocols that get hacked or ultimately are just being governed by a multisig, but you don't want to trade counterparty risk for smart contract risk. You want to make sure that the smart contract risk is understood, and that comes with strong audits and technical audits and sort of a broader understanding of people who are using these applications on what risk am I taking when I'm using a DEX. And then here also track record matters. So one of our clients, Uniswap is one of our clients, they're the largest DEX in the space, and they have a strong track record of helping users in a non-custodial way swap assets, hundreds of billions of dollars being swapped, comparable to TradFi exchanges. And that trust is also built through time of these smart contracts showing their resilience and their sort of solidity and how they can't be...
No pun with solidity.
Right, exactly. No pun with solidity. So yeah, I think it's a matter of time, infrastructure, but also then on the valuation side, making sure that the likes of the trusted industry assurance leaders are making these assets understood and the risks understood, and then the valuation the market can then assign to those risks.
Right. And what's interesting is I think that there's two kinds of like crowding risks that happen. Well, there's many kinds, but two that I think of in these situations. One is we talked about, the 1929 type thing, right? Which is really like, over-exuberance of the public or over-exuberance of people who are investing in things. And then there's the risk that you get from the trading community that should be more sophisticated, right? But, and maybe they're reluctant to get into something. And traders will say, I don't want to get my face ripped off, right? So, they're gonna, they want to be careful, but then they get to a point where they're like, I got to be in this or I'm dead, right? Everybody's crowding into this. That was the 2008, where it was like the average investor didn't really know the complexity of what was happening, but neither did the trader, right? Neither did, it was a layered onion, Just to go back to you, Alex, on this, how do you see, how do you manage that aspect of it? I wouldn't say you, because I think you're managing it, but I mean, how does the larger community manage that? And I'd also like to, build on what was just said, related to, governance, decentralized autonomous exchanges. How do you manage that aspect of things when you're aggregating these assets for your investors?
Yeah, I mean, so as an issuer, we don't. So our job is to manufacture the products. So we bring them to market. So we put a wrap around them. We list them on to the exchange. But what we also do is, as an issuer, we work with market makers around the world who are quoting our products on the exchange. And one of the key, I think, to build trust in the ecosystem for the product, you need to make sure that clients can buy and sell the product in an efficient, effective way. So we work with a bunch of market makers to make sure that you can buy and sell. Actually, the crypto winter is a very good example of how well do the products work. Because when you buy a product, whether it's a traditional product or whether it's a crypto product, it's all good and well being able to buy it. You want to know that if the market is volatile and you want to sell it, you can sell it as well. So when in 2007, 2008, in the global financial crisis in the traditional markets, a lot of markets just freezed up. You couldn't sell products, right? Same happened during...
Nobody knew that AIG was financing the world.
Right, exactly. But it was but there were some similarities between that and some of the days during the crypto winter.
Right.
And actually, when we go back and look at what happened and the way the 21 shares products worked, is that actually even the most volatile days of the crypto winter, our products were functioning in the way that we were wanting them to function, and that was because of the market maker ecosystem that we built around the products. So having a trading...
So the market functioned.
Sorry?
The market functioned.
Correct.
So did you need to, were there large stakeholders that needed to provide liquidity function?
Liquidity provision is critical. To do that, you need more than one liquidity provider. You need several liquidity providers so that if one isn't functioning, you can just kind of default to another liquidity provider. And actually, our clients, in those really stressful days in 2022, the ones that wanted to sell could sell, the ones that wanted to buy that could buy. And actually, that now makes up a very good case study when we're talking to investors about the way that the ETPs work.
It almost argues for a greater resilience in crypto
Yeah.
than there was in the traditional markets in 2008.
Yeah.
Because the markets just cleared, right? As opposed to having to have the government come in and bail it out,
Yeah.
right?
Yeah.
So it actually makes the argument that it's
Yeah.
actually. I think there will be many business students who will be.
2022 was actually, even though of course assets went down because the market went down, actually we had inflows in 2022. And I think a lot of that is because ETPs actually stood out as a trusted vehicle for people who wanted to invest into Bitcoin, into Ethereum, into Solana, into other parts of the industry.
Right.
Yeah.
No, that's great stuff. And just, Sean, and I'll ask you a quick question, and then we'll see if we've got any questions out here. But, just the risk concentration question, again, to someone who you might be, structuring a product for, how do you kind of lead your client through the concept of the kind of black swan event, market risk type things that they may need to deal with, without the backing of a bank and needing to, manage their portfolio and liquidity?
So we generally work with partners. Insurance is very helpful in black swan events, but it's unfortunately not tested very much in the digital asset space.
Well, 2008 again.
Yeah.
When your insurance provider loses everything, you've got no credit. They've got no credit.
So the partners that we choose generally are people that we know are listed or that we can sue, that they have some balance sheet. And that's the only way we feel comfortable in engaging with this space. And it's why for us Coinbase was the partner we wanted to find for the tokenization protocol, because we knew that they had balance sheet.
Right.
We're not saying that the DeFi lending platforms are bad, but not by any means. I mean, as we saw with Celsius, for example, CeFi doesn't work very well always if there's not great governance in place. And DeFi actually was pretty robust in that case. But DeFi can get hacked. And as we know that in that black swan event of a hacked DeFi protocol, there's nobody that you can sue. And so we wanted to have that happy medium where there is a partner that is building something with us that we can go after if in that worst case scenario.
A happy relationship of someone you can sue.
Well, good fences make good neighbors, I guess. Yeah.
But it's an honest answer. It's true. It's good. These are good things. So we only have a couple of minutes left. And I think we've had a really lively, deep, nerdy exchange here on things that are super cool if you like these things, which is why I assume everybody's here. Does anybody have any questions? Going once. Going. This is when in graduate school they just call on you. You. Did you read the case? So anyway, with a couple of minutes left, I wonder if anybody has any just extemporaneous thoughts that they'd like to throw out. Go for it.
Maybe one is that I think it's very easy to say, oh, there's no regulation, it's scary to build in crypto. I don't think that should be the sentiment that anyone should have going into this space. There are enough best practices and frameworks out there for you to build an excellent, with high integrity, a business, whether it's a payments business, whether it's a fund, whether it's NFT marketplace, DePIN, whatever it is. There's enough infrastructure and best practices around trust and assurance that you can build an amazing business on blockchains. So I would just want to say that no one should be sort of hindered by the prospect of, oh, how am I going to manage regulation and stuff like that.
Blake?
I think the point is culture and attitude, right? So do the right thing.
Right.
I remember I was, when the FTX crash had happened, and I was at London Token 2049, and because I was an auditor, I was literally on the spot. And people were looking at firms to blame. And my response was, you can do the right thing. Like the resiliency happened even during the crash. Brilliant example, right? If you do the right thing, you can survive. But so best practices are there. Just do the right thing with the right attitude and the right culture.
You know, just to put a bow on it, you know, I think that we've really covered the topic on assurance, that we have transparency, that we have systems in place. When you have all of those things, when almost all of the variables are known, either you believe in markets or you don't. And I believe in markets. I come from a long line of people who believe in markets. And I think the thing that I'm going to take away from this panel was that last exchange that Alex and I had, where we just talked about how the market cleared, like it functioned. If the market is working, if you've got a good product and the market can function and does function, that's the answer. You gonna say something?
Yeah, I mean, I would just finish by saying I think this is a really exciting time in crypto. I think I said how it's at an inflection point. I really think crypto is becoming mainstream. I think we're going to look back in 15 years from now. This is the very beginnings of it. But I think if we get all the infrastructure right, this is a really, really exciting space. We're seeing it. We're seeing regulators getting on board. We're seeing more asset managers getting involved, traditional managers. Obviously, the crypto providers are there as well. But I think this is just the very beginning. I think we've got a very exciting journey ahead.
I totally agree with you. I feel, and I said in the other panel, I've spent a lot of my nerd time like studying the history of money. And just like, I really have spent a lot of time studying the history or the transformation of our economy after paper money was introduced. And I really feel like there was that 1900 to 1917 period right before Paul Warburg put the Fed in place. And I really feel like we're kind of in that period where it's just exciting. There's green fields. People are trying to do the right thing. And I think the world is changing. So it's a good time to be alive. Thanks, guys. Thank you everyone.
Thank you.